I'm going to give my own spicy take or contrarian views. People don't have to agree.
Which metrics of these are the most important to look at that ultimately have the most impact on the volatility that we see in the markets?
There is no real danger of debt, at least for the next decade. At least.
Welcome back to the Rollup, your home for technical talks and open conversations that shape the modular future. Nothing on today's show is to be construed as financial advice. You can see our full disclosures list at therollup.co/ventures. Sit back, relax, and enjoy today's episode after a quick word from some of our awesome partners.
Redstone is DeFi's modular oracle, supporting over 100 clients on over 50 chains and offering 1,000 assets. Redstone is the leader for Bitcoin staking and yield-bearing assets. They offer the most robust, customizable price feeds available in any model. Join the Redstone exhibition today. GM. It's another beautiful day in the Rollup universe. We have our good friend Sam from Frax here today. We're going to be talking a little bit in general and then diving deep into Fraxtal and all the exciting things in the DeFi world happening on Fraxtal. Before we get into it, I love conversations with Sam because it tends to start pretty high level in general, and then we always find a way to connect the dots. So first, going to be talking about macro a little bit because crypto is becoming ever so more intertwined into macro with kind of like the new administration. We'll hit on recent developments and pivots at the EF and Ethereum world, and ultimately get into all the exciting things happening at Fraxtal. Sam, it's not your first rodeo. Welcome back to the show.
Yeah, it's good to be back, man. Yeah.
Good to see you again. Yeah, man. I mean, we talked just briefly before we hit the button here about macro, the rate environment. Fed is holding steady. Trump is in a tariff trade war, and begging or yelling at the Fed to lower rates. So as Trump took office and this kind of regime change took place, we're seeing more and more acceptance of crypto into a friendly regulatory schematic, for better or worse. Like, we're seeing regulation, but like we're really not seeing a whole lot of, regulation can be kind of thought of both ways, right? Depending on how friendly it is. And then also this global liquidity environment is kind of fragmented and all over the place with tariffs. So could you just kind of like paint the picture for us, how you're seeing things, and generally try to connect the dots and try to make sense of the way crypto is connecting to macro these days?
Yeah, for sure. I mean, the first thing actually is that, most recently for everyone, all the tariff stuff, right? Basically dumped crypto, especially altcoins for some reason. And then I was like expecting to see like the stock market or something on open like this Monday, like dump massively or something. And then it didn't as much, right? But then everything sold off this week, and it seems kind of weird because almost seems like tariffs affected crypto like more than other than BTC. It's been like hanging out at like 100K, right? One of the craziest things I guess is like the crypto market, since it like trades over the weekend, right? That's when like the main dump, so to speak, like happened, right? It almost feels like it's like a futures market for Monday trading, because like stocks don't really trade as much, but I don't know. Like right now, it seems pretty crazy because alts have been kind of bludgeoned and and beaten. But overall, I think like it's a weird time because everything is objectively bullish, but there's just volatility. And so like I tell the team at Frax, like when we work on stuff and everything, that for the long term of this year, and in crypto, long term, like year is long term and then 5 years is eternity, right? But so like when we have things that we do in Frax, we have like yearly like roadmaps, and then really long term. I think Frax is one of the few, like with like Ethereum and a bunch of other things like Uniswap and stuff, that multi-year views. But this year, objectively, it should be bullish unless there's like some kind of global conflict or something, which I don't know. It doesn't seem like it, but overall, I think the most important thing to consider is everything is coming back to the U.S. In terms of like how the new administration thinks of the world, right? Like the whole point is bring manufacturing back to the U.S., bring like crypto back to the U.S., bring AI back to the U.S. You know whatever you name it, bring steel, American steel back to the U.S. Right? And the interesting thing is Frax has always been US based, even when like during the prior 4 years when everyone was like getting out, people were like, well, why don't you go to Singapore, Dubai, like leave, everyone's leaving, you're going to get like basically disappeared, in the night by some Gensler like official or something. And we never left. And the thing is, now I think everyone that stayed has been able to benefit immediately, like the most, but also everyone coming back as well. We look pretty good at Frax, at other U.S. based, Robert Leshner, SuperState. They're in New York. I think Ondo is also in New York. The Uniswap. Everyone that basically has a bunch of U.S. Based presence has been eating well, so to speak, right? And I think that's going to be the main theme here. But in terms of price action, yeah, it's been weird the past couple of weeks. The volatility's just been through the roof. It almost feels like altcoins are like pump meme coins, the amount that they've gone up and down.
Yeah, it is wild. And I think, that was coming into this new administration, that was kind of the thesis, was like, if Biden got in, it was a nothing burger, or Biden or Kamala, it was a nothing burger. It was just, there was going to be no change. And, Trump came in, and his whole mantra is he's going to shake things up, again, for better or worse. So, he's also surrounded himself and the administration with experts, people that are not just political figureheads, but people that are actually all like boots on the ground making change. And I think part of that is leading to the volatility, but maybe it's just some growing pains. So, Sam, you donned a suit, pretty good looking tux out there in DC, up there with the political elite. I saw Rushi from Movement was also out there, and then quite a cool crowd that was in DC for the inauguration. So you were face to face with these people. Maybe you could kind of talk through what conversation you guys were having. What did you end up learning, and just overall the vibe in the room, and what were you hearing from the people that are going to be enacting some of these changes going forward?
Yeah, for sure. That was actually probably one of the coolest crypto events I've ever been to, because of just the sheer like you were saying, scale of everyone, like a who's who of everyone, and the optimism kind of in the room, right? I couldn't ever imagine 4 years like ago, right? There being like, oh, the new president will like celebrate like crypto in inauguration week at like a giant ball in DC. So it was great. I talked to ton of people, Robert Leshner from SuperState, who we're doing a big Frax USD partnership with, bunch of other people, Sergey Nazarov, Chainlink, long list, Brian Armstrong from Coinbase, everyone was there, right? And actually so many people were there, I unfortunately didn't have as much time, time to talk to a lot of them. Like Michael Saylor was there, right? But like only 4 hours. So it was really interesting, because I think everyone knows there's three big things in crypto this year, and those three big things are like strategic reserve. And I don't know what it really means, like U.S. based only Bitcoin, whatever. Like that, it's just the concept of the strategic reserve, right? Potential like tax and regulatory benefits for US based cryptocurrencies, or however you define that. Again, none of those are in any way like concretely defined. Like there's talks of like US made Bitcoin. What does that mean? If like mining in like in the US or something, right? Or US based cryptocurrencies like Frax, or like Frax USD or something, Ripple, I don't know, right? And then the last thing, which I think everyone that's like dabbles in this is on the radar about, is actual regulatory clarity and legislation, either a stablecoin bill, market structure bill, actual guidance from the SEC. And those are the three big things, right? Three big things is like strategic reserve of like the government, basically tax or made in America, right? Like benefits, and then regulatory clarity. So these three-pronged things, honestly, people thought that, just getting one of them, right? Like probably the most important one's regulatory clarity, but it really does seem like all three is going to happen, just like that's what I learned when I was there. And then since then, which it actually was like a few weeks ago, a lot of the executive order on the Strategic Reserve Working Group has been like signed, right? And then there's obviously the SEC has been properly structured with, I think Hester Peirce is like leading the working group of like deciding how things are going to go forward there, in terms of like no longer doing like regulation by enforcement, actually having some I don't know if it's going to be legislation focused or the SEC is actually going to do their own just guidance, but it all sounds much more proactive rather than in bad faith. So every single thing is extremely positive, especially for the US based cryptocurrencies and stuff, Ripple, Frax, Compound, Ondo, Uniswap, Uni, and stuff like that. But it's just crazy because of the volatility that,
Yeah,
yeah.
exactly. I think that's what the market is tangling with right now. It's like, okay, we're getting all of this like very positive sentiment that's coming from like the top of the power structure, and all of it is kind of like bringing in more positivity around crypto, starting businesses in the US, and just overall, the idea that it's okay to be in this industry, and it's now going to finally be, it's not going to have some oppression towards it. It's going to be almost like unearthed in the way, and unchained in the way that it can grow. And so we have all of that, but then in parallel, we have these global liquidity conditions that seem to be tightening. And I think that is kind of the dichotomy that we're faced with here. And so I want to kind of walk through like what this liquidity situation could look like, because it seems like after we figure out this liquidity part, then it's like cat's out of the bag. Then we're really off to the races, because we already have this whole framework in the works. And so I had mentioned to you beforehand, like been reading a lot of Arthur Hayes and kind of like the way that he lays these things out. And so, we've got kind of like this liquidity situation in the sense that, we had like high rates, and this is not just something that's, key for crypto, but it's key for the entire like stock market, bond market, the entire global macroeconomic landscape is kind of hinging on, one, the results of this tariff war, two, the results of, are we able to get the national debt under control? Because right now we're paying so much interest on this debt, and that is kind of the rationale for bringing the rates down. But we can't bring the rates down too quickly, or else the bond market is going to be way out of whack. And so, as you're kind of like looking at these liquidity conditions, and the idea that is that it doesn't really affect the builders in the room, but it's kind of key for the sentiment. So, as you're looking at things like kind of the bond market right now, 10-year treasuries are at, approaching 5%. Someone like Arthur thinks this is going to go higher because we have to feel pain before we can really bring the rate down. If we do get caught off sides, we could end up in like this deflationary cycle, because they're trying to make the dollar stronger. So, we have the strong dollar, we have the Fed interest rates, and then we have the 10-year treasury interest rate out there. Could you kind of like prioritize these things? Which ones are the most important to look at when we're thinking about like which metrics of these are the most important to look at that ultimately have the most impact on the volatility that we see in the markets?
Yeah, so okay, I'm gonna give my own spicy take or contrarian views. People don't have to agree. I love Arthur's writing. He's super cool at Frax. I think a lot about this stuff, stablecoins, DeFi, right? And like our one line motto is decentralized central bank, right? So it's like this is literally exactly what I'm thinking about every day. First of all, I think the national debt is very bad, but, and this is not popular, in crypto circles, but I don't think it's as big of a deal as people think it is. And I know most people don't agree with me at all. And I'm just gonna give explain it like I'm five view. Like literally, as you were talking, I pulled up the Fred and M1 money supply and national debt chart like right here. And like for people that don't know, M1 money supply is like the base monetary supply. M0 is like monetary stock, literally physical or digital cash. M2 is like the dollars that are rehypothecated once by banks, bank deposits, all this stuff. So if you look at the M1 money supply, it's about 18.5 billion. That means that's how much essentially like raw cash dollars, like slight different definitions, but let's just go with it and explain like I'm five raw dollars there are. There's about 30 trillion of debt, right? If you just for a second, just for 1 second, give me this funny hypothetical of if you just paid off the entire national debt by printing $30 trillion, okay? Uh, and we're just doing this very simply, just as an average, you would get $48 trillion in circulation. Remember, the U.S. can print dollars, literally, right? Like it can't default willingly, unwillingly. It only defaults willingly, right? And so if you essentially tripled the money supply and paid off every single cent of national debt that this government has ever created since 1776. Yes, most of it in the past decade, right? And numerically, everything would like triple in price, right? Because you triple the money supply. Again, we're keeping it super simple, super like explain like I'm fine. Some things would like 10x, right? Some things probably wouldn't budge in price, right? But on average, right? Standard pricing theory, right? Things would on average triple because there's 3 times as much money supply and like no debt. Obviously, this would destroy a bunch of stuff. We're just hypothetically thinking, things need debt and you need to save in treasuries, right? But just showing that the fact is if you actually repay every single dollar of the actual national debt, the worst case thing that would literally happen is the price of everything would triple and then there would be no more national debt. Yes, of course, you'd have to start, spending again. And yeah, that's bad and stuff like that. So I actually don't think everyone's like, oh, hyperinflation is around the corner. Hyperinflation is around the corner. I don't see it. And like look at the prices of like altcoins and crypto and stocks and stuff. I don't see it, right? If things dump, right? If things are bearish for those assets, it's just saying it's bullish the US dollar, right? Like a bear market is just a bull market for USD, right? And so my personal view, now, like, I know most people aren't going to agree with this, right? Is that there is no real danger of debt, at least for the next decade, at least in terms of like the debt bomb. Yes, it is increasing. Yes, like everyone knows. Some people is going to reply to this and be like, oh, we're spending every 30 days, like, we're adding like $500 billion or whatever it is, right? And it's like, yeah, if you pay off all of the debt so that you're not adding interest rates at all, you just triple the price of everything. It's very, 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 very far from Weimar Germany or like not, whatever it is, Zimbabwe, all these like, crazy like historical examples or something. It's very far. Now, coming back to everything, right? I actually think that it is kind of interesting with all these tariffs and everything. There's half of the people saying, oh my God, it's going to increase inflation, right? Because like the price of like necessities, CPI index items are going to go up because it's tariffed, right? Like if you have like steel coming in from Canada or something and it's like 30% more expensive, what's going to happen, right? Unless US manufacturing takes the place of it, right? But I actually think the opposite will happen, and this is actually goes to show you, like, all of these economic things. My philosophical view is they're all like voodoo because like they're not deterministic sciences, just because there's so many inputs that like it's not like I studied philosophy and neuroscience in college, so like everything I did like modal logic, like set theory and stuff, where it's like everything is very logically structured. Economics is great. Like, that's what I do at Frax. We design stablecoins, all this stuff, but it's not a very precise science. So like some people are saying, oh, this is going to increase inflation. So you're going to have to increase the interest rates, and that's really bad for the national debt, right? Because borrowing costs increase. I think it actually makes the dollar so strong that, like you were saying, the strong dollar, that they might have to cut interest rate if they actually go through with these tariffs. It's not like a negotiating tactic or something like that, which so far it kind of seems to be, right? Because they all got on the phone and like, oh, we'll defend the border. Trump's agreed to hold off on all this stuff, and I think that the opposite will happen if they actually go into effect, which means the Fed will have to lower rates. And Trump likes that because obviously he's always wanted Powell to lower rates. And so when you have this interesting thing in economics where there's this unknown variable, right? Tariffs and stuff, right? And literally both sides of the conclusion sound possible. At least I'm not saying they're both will happen, but like it seems intuitively valid where inflation will rise, so they'll have to raise rates to keep inflation from skyrocketing, right? Or the other side is people will hoard dollars so much, right? Like the value of like crypto stocks, other industries, all this stuff, these indexes will like dump so much, like COVID, right? That they'll have to lower rates, right? Because like otherwise, the economy will grind to a halt, right? Like people won't actually like build stuff because they'll just be hoarding dollars, right? Because they need to buy the necessities and like pay people and all this stuff. So when you can go both ways, it's kind of funny to me because that shows always in economics that like there's a bunch of hidden variables and like you have no idea, what the fuck's gonna happen. Same thing with like the tariffs, where it's like tariffs have always been controversial because some tariffs do work, or that's what like the research shows, and then some tariffs, depending on what they are, has shown that it just gets priced down to the consumer, right? Like the classic thing of when people are like against tariffs, they're like, look, all you're doing is just destroying economic wealth for both sides, the tariff side and the side getting the tariff, because it increases the cost goes down one layer and then down one layer, and then the consumer always ends up paying for the cost. That's very, very true, but it's not always true. For example, oil tariffs, they don't necessarily get paid down to the consumer because the production capacity is decided usually by state level actors that actually always, like OPEC, figuring out how much they actually want to enter and put into the market. So like all this stuff is just always interesting to me, but most of it is like it could go literally intuitively both ways, and it sounds valid. And so whenever that happens in these situations, I always just get back to work at Frax, just like build something, because I'm like until there's more independent variables that you can isolate and stuff, and then measure like a single dependent variable, it's all just funny. Like it's like astrology for like men, or like or people who think they're smart or something. I saw this meme before where it was like everything is like Bitcoin holders, like retards who think other people are retards, right? ETH is like broke retards. Did you see that one? And then it was like I forget what it was for like Solana, like it was like retards that trade retarded thing. I don't know, but it was just like really funny because I was like, okay, well, this is actually kind of the truth. People just like doing this without knowing. But one of them is right. There's just evidence for both of them being possible, and then one side will think they're a genius once the event horizon passes. That's always how I've seen this stuff, and that's why I like Arthur's writing. It's funny. Like when you read it, you get like entertainment out of it as much as you consider new things, like how the interest rates might like increase demand to like increase demand for T-bills, making it harder to borrow, et cetera, et cetera.
Yeah, I mean, you make a great point. Like as a builder and an entrepreneur, you can't spend all day thinking about these things. There's kind of a couple approaches. You either see the forest through the trees, and you're like, and these are connected because you essentially look at the scenarios that are out there. Okay, maybe all of these are plausible, right? And as whatever happens, it's important to be prepared and think like, okay, well, this situation could go this way, the situation could go that way. But regardless of which situation occurs, there's still like the effect that happens afterwards, and being prepared for that, no matter what happens, is important so that you put your business and yourself in a position of success, irregardless of which path is taken. And then it allows us to kind of like forego what is outside of our control and just focus on what comes next. And I think you're absolutely right. I mean, no matter what happens here, it's like, I tariff you, you tariff me back, I tariff you harder. We end up in the place where like, okay, everything has a bajillion percent tariffs. And so ultimately, that cost gets passed down, inflation goes up, Fed raises rates, market grinds to a halt, nothing happens, so we have to cut rates. These things are like these games are not sustainable. So ultimately, I think we end up falling back on some kind of free market economics. It's just a matter of how long that takes and what path we take to get there, because ultimately these things are path dependent. We don't want to crush the economy in doing so if we're just going to end up at that checkpoint anyway. And so I think, it is important to stay aware of these things, but not get too caught up in them. Ultimately, the things that I think Bitcoin, cryptocurrency, and decentralization stand for are going to be important irregardless of what happens in this immediate term, because we're playing the games, whether, you think Bitcoin is the global reserve currency and you think these things are going to get devalued against Bitcoin, or you think they're going to get devalued against the dollar, and then, we're going to cut rates and go from there. A lot of this is still extremely applicable. And I think like you said, we can just kind of hunker down, keep building, and see the forest through the trees. How we deal with that isn't so much important in the short term; it's more important in the long run. So you've been able to navigate this, and I do like the idea of kind of looking at, okay, these are some global macro liquidity landscapes, and then we kind of mirror that when it comes to on-chain centralized, not centralized, but the on-chain decentralized central bank, right? So you also have a monetary policy at Frax where you guys are kind of, how much, maybe it's programmatic, maybe it's decentralized, but how much do you guys take into account the monetary policy of issuance and reserves? How are you thinking about that when it comes to the stablecoin monetary policy at Frax? Imagine if the world's GDP moved on chain. Guys, say GM to SafeNet. The newest protocol by Safe isn't a blockchain, and it's not a new layer 2. It's a transaction processing network built to send money anywhere and swap anything on thousands of layer 2s from a single universal balance in sub 500 milliseconds. It's fast, it's smooth, and it's simple. And it's built with safe multi-sig level security in mind. SafeNet unlocks smart accounts across multiple chains, allowing users to supercharge security, scalability, and speed. So get started today at net.safe.global, and remember to follow @safe on X.
Yeah, so that's really well timed in terms of like what we're doing actually, because I think by the time this airs, we'll probably have launched FRX USD, which is our flagship product. Frax originally came out as like a decentralized stablecoin, the Frax dollar, and we're launching a totally new stablecoin, FRX USD. It is actually pretty unique in design, although it's subtle. It sounds kind of the same as like a fiat coin RWA, but the main thing with it is it separates issuance from custody. And so basically, FRX USD is issued by Frax, and then we have strategic partners that it's called enshrined custodians, which is so far BlackRock and SuperState. And what happens is anyone can mint or redeem FRX USD, and then the funds are held by either BlackRock or SuperState in T-bills, right? There's like risk-free, bankruptcy remote, short-dated T-bills, and you can mint or redeem from them or on-chain from the representation of their token, right? BlackRock is BIDL, right, by Securitized. SuperState has USDB. And then there is an SFRX USD, which is the yielding token, and it's a high-yielding stable coin, and that we can also do the carry trade like Athena, and also have the base T-bill rate so that whenever, no matter what market condition, if you hold SFRX USD, you're getting the best risk-adjusted rates, right? You could always step up the ladder in like crypto and like implode or something, but the best risk-adjusted rates possible on chain for a savings account. Actually, the macro for stable coins, I've totally changed my view originally from what I've had. Frax was originally founded in like 2020 as this completely decentralized, the Frax dollar, totally. There's no BlackRock, RWA partners, all this stuff. But what we designed originally with Frax's tech was protocol-owned liquidity, minting the decentralized, Frax stablecoin in lending places like Aave, our own, Frax Lend. We basically invented that. And like if you think of what that is separating issuance from custody, right? Except the different protocols are the different custodians. People just don't call Curve or Aave or something custodians of stablecoins, right? But we actually invented that on a decentralized level. But now, because things have really changed, right? Like 4 years ago, I could never imagine being invited to a crypto ball to celebrate the election of the president of the United States because he really likes crypto, right? I think that the main thing that we're considering with FRX USD and just stablecoins in general is, what does a stablecoin have to look like to be one of the few trillion-dollar stablecoins in the next decade, right? In the next 10 years, there's almost certainly going to be 2-3 stablecoins that are over $1 trillion. Most likely, it seems like Tether's going to be one of them. They're farthest toward that direction, probably. Probably USDC, and who knows, maybe one or two. And so our idea is, what does FRX USD have to look like, and what design for it to be like that? And what we came with is the same principle of separating issuance and custody, but the custody is in tier one institutions. We have other announcements as well of partners that are coming. And the idea is they all have an incentive to increase FRX USD usage, right? Because they get to custody the funds, right? Like not us, right? And so it's very different than like Tether or Circle, for example, where the entire stack is fused in like one, right? Like they custody their funds just through Cantor Fitzgerald, like Tether, right? And so like they're just one product, right? Whereas with us, if you have an account at BlackRock, Securitize, SuperState, right? All of the other things that are coming, you can mint redeem from there. And obviously you don't have to, just like most people don't redeem USDC. It's a pretty decentralized custody and issuance, and the custody is very, very transparent, tier one institutions, and there's obviously high yielding stablecoin, and everything works in parallel to actually get the currency integrated everywhere. And so this is totally different. In fact, like we've had conversations with a lot of other big institutions, RWAs, people wanting to come on chain and say, hey, like we see that you're about to launch FRX USD. Can we actually service this? Can we actually be like a custodian for it? And we will get like our subscriptions for other, products in FRX USD rather than, or usually in addition to USDC, right? Everyone accepts USDC in and out, but like we haven't even launched yet. And so people are like, well, we're going to start working on integrating it because they are part of the custodial layer of the funds. And it's in their interest that FRX USD wins out over USDC, because I don't think they custody anything for Circle, right? Or at least no one other than like their like the T-bill fund or something that Circle has set up. I think with BlackRock maybe, but like it's just one entity, right? Everyone else doesn't custody anything for Circle, and so that's the really interesting thing. And from a stablecoin perspective, like the thing we're thinking about at Frax is like I think are probably one of the most stablecoins in the sector, one of the most important for the dollar. We're just talking about dollars and like the strength of the dollar, borrowing and all this stuff, is like, if we can get $1 trillion worth of T-bill demand, right? Because like Tether's basically created $140 billion of T-bill demand, right? If we can, for example, at Frax, create $1 trillion of T-bill demand in the next 10, 12 years or something, right? Then we've done a pretty patriotic duty, if you think about it, right? Like the amount of economic value we've created for the U.S. That's how I think about it in our framework. The amount of additional borrowing capacity for the government that we've created. Hopefully, it's put to good use thanks to Elon's Doge and stuff, and like less like wasteful or whatever. But that amount is immense, right? And that wouldn't honestly be possible. Some people are like, oh, well, someone else is just going to buy the T-bills if like stablecoins didn't exist. Not true. Not true. Literally, like the stablecoin technology, the ability to settle quickly, 365, 7 days a week, anywhere that's internet connected, that actually literally creates value out of thin air for the dollar that didn't exist before. The efficiency, the liquidity, that is the value. And so I think stablecoin is probably the most patriotic thing you can build if you're if you're into that, like serving your country through crypto. And the other thing that I was just thinking about yesterday is, as you guys know well, we have our Frax still L2 Rollup, and we have actually huge tokenomics change for the FXS token that's like gonna be coming, and I'm super excited for it. And so it's kind of gonna become an L1 token actually, but probably podcast for another day. But the thing I was thinking of is if like Frax USD gets to like trillion market cap in like 10 years or something, or like a thought experiment instead, forget that. Imagine if Tether launches Tether Chain, right? And then they actually tokenize the T-bills that back USDT on Tether Chain, right? And this Tether Chain would already have 140 billion of like TVL if you think about it, right? Some people would be like, oh, well, it's not like real, it's just RWA tokens. But I think it's substantive in a way that it'll get other people to issue assets build on Tether chain. Now, I don't know of any plans for Tether to launch its own chain, but one of the things that made me realize with like thinking about it like that is stable coins are probably the best gateway drug, so to speak, or gateway technology to actually onboard people to blockchains, both developers, also normal people, just literally everyone on average. Like if you think about it, maybe developers are more excited about like, oh, how fast is this thing? Or like, is it, this or that? But actually a lot of the things today are like, is there a fiat on off ramp? Can I actually get as many users as base? Or like, can I actually have a credit card with this direct mint deposit from your blockchain, right? Like Fractal base, which is yes, right, and stuff. And for us, it's yes after FRX USD, right, which is the whole point of all this. And so, yeah, that's basically my overall view of the stablecoin and DeFi space.
I love it, and I love the thought experiment about reaching a trillion in issuance. And I have a question on the back end of this, which is that, well, first, just to kind of trace this through, the Treasury is essentially, it auctions off these bonds, and it has a white list of actors that can come and purchase these bonds. And so people come in and they basically buy these bonds off the market from the Treasury. They place bids and they buy them, and then the Treasury ends up getting dollars that they can use to finance the government for all these programs. Again, hopefully that's like put to good use after we kind of clean out the waste. And then the people who buy that's normally other foreign central banks or other nation states or very big banks take custody of these treasuries. Now, they are kind of like this centralized group of buyers of these bonds and the largest holders of these bonds. However, what you're talking about is democratizing this auction. You're talking about putting bonds in the hands of people that just any one person, like think about like, South America and Africa and underbanked communities that currently don't have access to banks. That was I remember you're part of this like early 2017 crew about banking the unbanked. And those are currently the regions that are there. And so stable coins are purpose built for those communities. And if we can bank them through a decentralized alternative, now they can use stable coins to go purchase things and to go transact and trade. And, what are they using? They're using treasuries as the reserve for those stable coins, right? And so not only are you doing a patriotic duty by sourcing liquidity, you're also doing it in a more sticky, decentralized way, because now you have a more distributed set of treasury holders. And I think that is extremely important for those who are financing the government. They're not people and banks that are, putting on carry trades and then going to go dump a whole onslaught of treasuries. You're actually putting treasury into liquidity, into the holders of people that are ultimately going to be using this on a day-to-day basis. And that creates a much more distributed network of holders. Just like token holders, you want a distributed set. Putting treasuries into the hands of people, they can use stable coins that ultimately help them transact, but you're distributing treasuries into a larger, more distributed set of holders, which I think does a service to the government and makes it stickier liquidity. So that I think is extremely important and is a patriotic duty. Sam, thank you for your service. And I think it is ultimately better for the bond market as you decentralize and distribute the holders of these bonds in a more geographically and socio distributed way. And so I think that is a global positive. I want to ask just kind of one more about the mechanism here. The idea is that, we issue these treasuries and we custody those at these tier one custody partners. And then we mint stable coins that are backed by these treasuries. And you can basically, you can cash in your stable coins and you can take custody of the treasury or the dollar. I think it's intuitive that, once you have a treasury, you can borrow against that. You can essentially collateralize it, and then someone will issue against that. Do we end up in a scenario where we have an off-chain? Let's take the $1 trillion number. For instance, we have $1 trillion of treasuries in a vault somewhere. Call it BlackRock, a custody partner. We issue another $1 trillion of stable coins against those bonds. Once we issue that trillion on chain, can we then borrow against it again? Can we then just rehypothecate, but collateralize this debt further and further and essentially create more wealth as a result of this collateralization? And if so, does that increase M2 to an extent where there is more dollars in circulation? Could you kind of walk through the economic theory of the issuance in this case?
Yeah, that's a really great question, and actually a point I wanted to make before, which is that actually Brian Armstrong had a really good tweet the other day. Let me see if I can find it here, which is
if you send it to me, I can pop it up on the screen.
Yeah. Oh yeah, it's actually right here. And so the way that he said is there's a lot of reasons things are separated in the old global financial system. Some of them not good. Some of them are good. So actually here it is, I think. Anyway, but I think the most important thing is that essentially what you want is you want to actually bring value and credit out to the new. So you want to bring actual liquidity and credit to things in the traditional financial space that would just sit in a little bank account, right? And so or a brokerage account. And so one of the things Brian says, why does your bank account not give you T-bill interest, right? They just, the way that banks are structured is they take most of the interest and hope you just need banks because they're forced to actually, you're basically forced to deposit in banks to live, right? To live a life, to pay your bills and all this stuff. Some of the reasons things are separate in the global financial space is for good reason. Conflicts of interest, historically, you can't have both someone that custodies your funds and trade against you, FTX, right? All that kind of stuff, right? But a lot of these things, there's no good reason for them to actually be separate, right? Why does the money you spend lose value, right? Instead of growing in value? Why does your checking account not earn yield, right? Why can't you just actually get a loan for the T-bills that you have, while you're spending them? Why can't you just spend the T-bills, right? And so stable coins allow you to essentially, like you said really well, tokenize things that would have just been stuck in a brokerage account otherwise, and give them essentially superpowers, liquidity, settlement value. Whereas before, in theory, you could do a lot of these things. In practice, no, you can't. It sounds like, you could, but no, if you could, you would have already done it, right? It wouldn't have been a like niche kind of thing of like spending your retirement thing from a credit card special account or blah, blah, blah. There's nothing that can beat stablecoins. Literally, objectively, I think that ship has sailed. Is no longer anything to even talk about. And it's an interesting point that you said, well, if you tokenize all of these things as essentially cash, which is what stablecoins are, does that essentially increase the M2 money supply? Sort of. Depends on what you're, again, all M1, M2, M3, they have pretty strict definitions, right? Like they're, M2 is certificate of deposits in banks, which means they're rehypothecated once, most likely for like mortgages, like business loans, high rated businesses, right? M3, a little bit more degen, as we like to say, right? M1 is literally just monetary stock deposits. M1, M0, basically the same thing. If a stablecoin like FRX USD simply just is tokenized representation of a T-bill that's in a bankruptcy remote professional custody account at BlackRock, and it's not hypothecated again, at least not until the user has it and stuff. I think that actually deserves like a new like M1.5 or something, like a definition. And obviously, like you said, then they can use it as collateral on Aave or Frax Lend, all these places, because it's a very, very pristine safe asset, and then borrow against it. Then it's M2, right? Then it's definitely that's like the definition. And that's a really good point in terms of like what effect that has on inflation. I think I'm a pretty big believer of Jevons paradox, or however you said, which is like anything that increases, if the price goes down, it increases demand rather than the other way. All of economics, right? It's like with oil. Like if the price of oil goes down, the demand for it actually goes up, rather than the price going down and everyone's like, oh, we don't need oil anymore, right? Or like oil is bad. And so, coming back to the thing I was saying, economics is just all about just this astrology of like price going down. Is that bad or good? Maybe it's good, maybe it's bad. Tariffs, does that cause inflation or deflation? And it's like intuitively it could be both directions. But I'm a big believer of like when these T-bills are essentially transformed into cash, not only is it not going to lead to inflation, it's going to be like Jevons paradox of like the increase in liquidity and cash into the market is actually going to lead to a massive amount of growth and credit opportunity, because the T-bills were already there. They just were not able to actually, be settled easily and actually be transferred. People, like you said, were already buying them, right? But there's now net new demand on treasuries because they have this additional function, stapled on top of each T-bill certificate that allows you to use them in cyberspace. And so I think that's actually going to increase wealth, prosperity, and increase the actual ability for people to fund their businesses, the government to fund its functions. And that's my view of it. But you're right in the sense that, stablecoins are essentially unlocking the things in traditional finance that actually were not possible in the old classical system, especially like Brian said. Reasons that these things are separated, some of them not good at all. They're just historically they were like that because of technology, and now we're completely stripping away the ones that should have never been separated, right?
Yeah, and I realize we're tight on time, so I'll make this real quick. But I think you really hit on the nail on the head as you're talking about stablecoins leading to basically opening channels to more prosperity, because it's not so much the idea of more dollar supply and more liquidity in the ecosystem. Yeah, that's great. Essentially, if there's the same amount of stuff and there's more liquidity, it means things are more valuable. Okay, great. But what really provides value is the velocity of money, and utility is what opens these channels. And so if we just, print a bunch of money like we were talking about in the beginning, that's great. Maybe we'll increase M2 or M1 or M3, but what really builds value is the idea that we can turn these treasuries into a productive asset. If we can increase the utility that people can do with these treasuries or these dollars by tokenizing them, and now people can borrow against them or trade them or stake them, and it opens up these new primitives, it means that we can do we can do so many more things. And the velocity of money changing hands, buying things, selling things, that's what breeds a healthy economy. And I think that is only possible through stable coins and the act of tokenization. So absolutely, the idea that we can actually make these things like more productive and more liquid by opening these channels through tokenization is, I believe, what is really the true power of stable coins. It's not just adding more money to the supply, but it's opening doors and channels for this money to move in ways that it wasn't possible before.
Yeah, I mean, I think you said it really well, and I wanted to talk about ETH, Solana, and stuff, but sounds like it's a different episode because this is so good. And like, what I want to just add to that is exactly as you said. Imagine, people are always like, oh, why does Frax have a fractal chain and stuff? Now I can say it clearly is, imagine if our flagship FRX USD has $1 trillion in market cap in 10 years, right? 2035. I can guarantee you Fraxel Chain will also be at least $1 trillion in TVL and one of the largest blockchains to ever exist, right? And like, now people kind of understand how, and that's a credible, thing to say, because thought experiment like the Tether chain, right? Thought experiment of bringing all of these primitives, RWAs, onto the actual chain so that the actual banking, the collateralization, the minting and redemption, and this ecosystem of builders around all of this stuff, this utility that comes out of all of these classical financial units, right? Treasuries, debt, all of these things is built programmatically on the chain, right? With agents, other things that can manipulate them, bring value out of them, automate them in ways that literally have never existed until very recently. And so, like, that's our theory. That's why there is a fractal chain, right? If FRX USD and fractal chain continue to grow, they're actually very, very, very symbiotic, rather than, oh, it's just a separate product. In fact, that's the way I've started to think about Frax when people ask about it. To explain it to them is like, think of if Tether had Tether chain, and then it would be at like 140 billion right now. Wouldn't that be pretty interesting, right?
Yeah.
And so that obviously goes down the segue of like L1 tokens and like how these things should be valued, or like how important are the fees, or if it's like a commodity. And you always know I love talking about those things, but they're different than stablecoins. But stablecoins are what I'm a personal maximalist in, the self-proclaimed stablecoin maxi.
I love it. I mean, I think I am I'm becoming convinced, because this whole entire conversation has reshaped the way I'm thinking about money. I'm realizing money is essentially credit, because when the US prints money out of thin air, what are they doing? They're essentially, they're saying, like, here is this piece of paper. I will make good on this piece of paper. It's, that IOU. And that
Well, wait,
that
let me actually ask. Let me ask you. When you say I will make good on this piece of paper, right?
yeah.
What will they make good of? That's always something I always try to drill home in people, is like, the thing that they will make good of is the CPI peg. The dollar itself is a stable coin, right? And like, sorry to interrupt you with it, but that's a very, 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 very astute thing that you said. That's so correct. But people forget to add, what is it that you'll make good on when you issue a dollar? If like the Fed was like, I'm gonna flip a coin every day, and if it's heads, I'm gonna like print double, or if it's tails,
Right.
I'm gonna buy a third. Yeah, no one would hold dollars until they're about to be forced to pay taxes. So then you just buy the amount that you're owed right at the moment of like paying taxes, right? Similar to like gas account abstraction on blockchain. Like, you only buy the amount of ETH right in line with like and no one would want to hold it the same way it would be so volatile, right?
Yeah.
The main thing is that the dollar is a stable coin, and the peg is CPI, and the only entity in the entire world that has the most credibility to keep a peg is the United States government. Sometimes even they screw up, right? Like
The Federal Reserve in particular. Yeah. Yeah, because they're the ones that are keeping the dollar in line with the 2% inflation mark, right? And so that when we say full faith in the U.S. government, it's the faith in the Federal Reserve to maintain the peg to the 2% inflation mark, and then we hypothecate from there, right? So then, okay, we have this IOU that the Federal Reserve and the government is going to make good on. Well, all right, we're gonna give that, and then we're gonna these entities, big banks, nation state, other central banks are going to buy those bonds. They're going to then give them to custody partners. Then we're going to go mint them on chain. This is all extending credit. And I think the credit extensibility is what is leveraged by on-chain stable coins, because then we can extend credit further, and we do so in a productive way that increases velocity. And it means that we can open up more credit faster and more frequently than any other technology is able to do and progress credit in such a way. The blockchain does it best. So I love when these things just really strike at a very deep fundamental level on the way that we think about money, technology, and ultimately how we value things.
Yeah. I mean, think of the economic value and coordination that's created when all of stablecoins, banks, everything coordinates around the US dollar. None of us are talking to each other, right? I don't have meetings with the Tether, CEO Paulo or something. I don't talk to Jeremy Allaire. I don't, talk to, sometimes, but we're not meeting about like, oh, how do we, keep all this stuff? We outsource. We essentially coordinate. There's the shelling point of the dollar unit is what we've all essentially agreed to create our debt, right? The stablecoins are our IOU for the entities, right? FRX USD is technically.
You guys are extending that credit to the Frax holders.
Exactly. And so like this unit being the same across everyone literally has extremely deep liquidity. You have places like Curve, all of these liquid sources that can have deep direct liquidity. And that's why people can see dollars are so deep in liquidity, but volatile assets, there's wide spreads and there's all of these things. And literally by coordinating on a single unit, even globally, like not even on chain, just globally, the amount of wealth created because of how liquid and useful like human like society coordinating around a single unit is, it's very powerful. And so people kind of miss that, like miss the forest for the trees there. And obviously it's good for the US that they're the ones that are able to mint this unit. There's a lot of people that are like, well, it should be Bitcoin or something, right? Which is an interesting thought. But it's obviously very good if you can mint the unit that the entire human like species is coordinating deep liquidity around, denominating their debts around, and savings around. And that's actually an invention, right? People say money is like an invention. Yes, money is a social construct, right? But actually coordinating around a single unit for debt denomination and savings is a secondary invention after money that is, I think, equally profound. People miss it because like a higher order like abstraction invention, but and you see it on chain too on a micro level, right? Like the fact that stable coins have much deeper liquidity than volatile assets. They're much more useful in debt denomination and savings than yielding assets compared to them, right? So
yeah, I mean that's absolutely true, and there's further inventions that further extend credit and further elevate the order of abstraction here as well in on chain, and then further extend from there. So these are absolutely equally profound inventions as we continue to move further and further progress the monetary base into the hands of more people and extend this even further down the supply chain. So yeah, I love it. Sam, you're doing great work. Serving the country well. Thank you very much for your service. And yeah, I love these conversations. Always walk away learning something. So thanks.
Thanks, man. Always happy to be on.